Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Okay, we're going to go ahead and get started. Good afternoon, everyone. Welcome to today's webinar. Today's session is going to be hosted by Jason Ayres, who will be teaching us about reducing the cost of your trades using ISE FX Option spread strategies. Jason is president and founder of OptionSource.net, providing education and opportunities in the stock and options market for over 5 years. OptionSource.net is one of Canada's leading educators for trading stocks, options, futures, forex, and commodities. We'll just turn it over to you now, Jason. Thanks.
Great, thanks very much, and I'll just do a quick sound check myself here to make sure the audio is working, and perhaps we can get a confirmation in the chat box that you can indeed hear me before I do get started. Good stuff. Well, thanks very much. As always, it's a great opportunity to be here presenting on behalf, of course, of OptionSource.net and as a guest of the ISE. Tonight we're going to focus on, as mentioned, reducing the cost of our trades utilizing FX options spreads. We're going to kind of build on some of the concepts we talked about in the last session, which was using more expensive options to generate income, and we'll talk a little bit about the principles that go into influencing an options price and what makes an option considered to be more expensive in certain times than others. Of course, always want to just reinforce the importance of understanding the risks involved in trading options, no matter which strategy you're looking to implement. Always understand that there are risks involved, and before you actually start clicking the buttons in a live trading environment, make sure you spend a little time in the simulator just so that you understand the dynamics of the market. So with that in mind, folks, just a quick reference to the actual ISE FX options as a product here. One of the great benefits of being able to, or understanding the FX options available at the ISE is the fact that they're accessible through any standard options broker. So rather than having to go out and trade your currency views in the spot market, you can actually, and of course opening up a specific broker for that, you can actually trade your views with any of your standard brokers that offer options as a tradable market. They are cash settled in US dollars, so there is no underlying security that is settled out. They're simply settled for the difference between the strike prices and the settlement value, which happens to be the noon rate on the expiration Friday. So European-style exercise, and of course, many of the strategies that we would look to implement on the equity options trading side, we can actually apply in the FX options side as well. So we can, in fact, trade these particular options as spreads. Now, just a little bit of insight as well as to some of the things that are offered on the FXOptions.com site. We produce a weekly FX options outlook, which essentially gives any viewer an overview of the more popular traded pair values. We really just take a simple technical outlook, determine the probabilities of a direction, and look at some key support and resistance levels that might come under consideration for trade management, and also be of consideration, of course, for creating strategies around as well. The principle behind technical analysis, of course, and there are a number of recorded webinars where we focused on this topic, is really to look for clues to help us with trade entry and strategy selection, as well as where appropriate levels might be sitting for us to lock in profits when we're trading these particular options contracts. One thing that we always try to reinforce, of course, as well, is that we need to keep an open mind and understand that this market, of course, as of late, has been very indecisive. We've had some very significant moves, and of course, that's one of the benefits of utilizing options, is that we have a limited and identifiable risk exposure. But we want to understand that we're not always going to be 100% right, and we need to be prepared to cut our losses when and if it is appropriate to do so. So with that in mind, let's just take a look at some of the considerations that we might look at with respect to determining whether or not it's appropriate to utilize a spread strategy. We talked last week about periods of high implied volatility being a good time to be an option writer, and that was as part of a income-generating strategy. However, we have to understand that during periods of high implied volatility, and these, of course, are times when there's a lot of indecisiveness, call and put options can be expensive. What that means to the option trader is that we're actually putting more capital at risk, and of course, the more it costs us to participate in an opportunity, the higher our break-even point is going to be, and the more significant a move in the underlying pair value needs to take place in order for us to recognize the profit. So what happens is, as an option buyer, we often seek to offset the cost of the more expensive options by utilizing debit spreads. So it's a very simple strategy. We're not going to get overly complex tonight, but what I wanted to do is just talk a little bit more about some of the different considerations when we're using debit spreads, some of the benefits and some of the drawbacks, to ensure that you understand when you make the decision to use the strategy, really what you're getting into. Now, the question comes up, how can we tell whether or not an option contract is expensive? Well, the whether or not an option contract is expensive or not is just excuse me one second. This question came up whether or not I was advancing the slides, and absolutely I am advancing the slides. And maybe it's just confirmation in the chat box from some of our attendees that you are in fact seeing these slides advanced. I am advancing them on my side, but I've just had an indication here that perhaps you're not seeing the slides being advanced. I'm not seeing any confirmations in the chat box either, folks, so perhaps we can, we'll just kind of hang on one second. We've been having some issues with the WebEx software as well on our end, and evidently the same thing has happened on the other side with the ISE account as well. So again, if anybody, and I'm not seeing any questions or anything come into the Q&A box. So, okay. So for some reason, and I'm just wondering, perhaps it might be appropriate. I'm not sure whether or not, Lauren, you've actually made me the presenter here. I'm advancing the slides on my end here, but unfortunately, I'm not. I'm not seeing any questions coming through or anything. Maybe just a confirmation, Lauren, as to where we're at. All right, so we're at the page that is titled "How Can We Tell?" So here we are. You're actually moving forward to the slides. I don't think that I've been made the presenter actually at this point. So I'm at the page that suggests "How Can We Tell?" And I think perhaps if you actually right-click on my name, there we go. I think this might do it here, and perhaps you can confirm at this point whether or not. All right, guys. So are we seeing the? Perfect. Good stuff. Sorry, folks, but sometimes in the world of live entertainment here, a few glitches come up. But so let's get back to the start of this slide. How do we know whether or not an option contract is expensive? Well, it's really based on two, or more or less one specific observation, and that is historic volatility, or the historic volatility of the underlying security. So we understand that option contracts are very much priced on probabilities. Is a particular strike price going to be in the money on expiration? What are the probabilities of the stock actually, or the pair value, or the underlying security actually making it towards and beyond that particular strike price by expiration? So the price action or pair value action of the particular security, and we refer to the FX options indexes as the pair values. So the pair value of a particular option contract will obviously will change in value over a day-to-day basis. So it is really how fast and how far a particular security is moving over a certain period of time that determines the historical volatility. So it's the realized volatility over a given time period, which is usually calculated by determining the average deviation from the standard deviation from the average price. So it gives it's a quantifiable measure, and it actually gives options market makers an idea as to whether or not a specific contract has a high probability or a low probability of finishing in the money at the expiration date. So what they'll do is they'll essentially price the option contract based on those probabilities. So the higher the historic volatility, the higher the probability the underlying security is actually going to make it to beyond the strike price, and the more the options writer or the more the market maker has to calculate that or factor that into the option premium. So the implied volatility factor, or the IV, is applied to the option premium and reflects the estimated or anticipated volatility of the security's price. And again, what happens is that during periods of indecisiveness, when we've seen very significant moves up and down within a particular pair value, and this has been quite evident in the currency markets, then you will see options prices expand to reflect that particular increase in volatility. So what I did is I took a snapshot from the FXoptions.com site, and this is essentially just a little bit of information on the CDD, which is the U.S. dollar versus the Canadian dollar pair value. And what I just wanted to reference is that you can see that there is a historic volatility of 11.74, which is reflecting over the last several weeks, it's reflecting the average deviation in price, either up or down. What we can see here is that the implied volatility is actually higher than historic volatility. So market makers are in fact pricing in a very volatile move, or a highly volatile move is being expected in that particular underlying. And so what happens here is that when implied volatility is higher than historic volatility, we would actually consider the option contract to be expensive. Now that's not necessarily always the case, because if we have had a significant move already in the underlying pair value, and you know, that will obviously factor into the option contract premium as well. So the option contract may be in fact very close to the current historical volatility, but it's still reflecting a higher price than normal because of the preceding movement. So nonetheless, what we need to consider is what is that measure, or how is that measure viewed in the option contract? Well, the Vega, which is one of the option Greeks that is used to label a particular variable in the pricing model, in fact, is the measure of the implied volatility factor within the option premium. And so what happens is the higher the Vega, the more significant impact that move in the underlying volatility is going to have on the option premium. So the Vega, in fact, reflects the amount that an option contract will change based on a 1% change in implied volatility. So, for example, if we have a Vega of 0.35, and incidentally, I'll show you where you can find that measure. Well, what that means is that the option premium should increase or decrease by 35 cents with every 1% change in implied volatility. So, in other words, if a market maker, if the market maker deems the option contract or the underlying security as being a highly volatile security, and they want to change the implied volatility of the option contract, they will adjust the Vega, and you will recognize that, of course, the change in influence of that 1% move is going to increase or decrease. Now, one way that you can offset that is by utilizing debit spreads. So if we have a bullish outlook on a particular pair value, what we can do is we can use a bull call spread. Now, that requires us to buy one call option and then sell off one higher strike call option at within the same pair value and, of course, at the same expiration date. So this is not a strategy that many of you are unfamiliar with. It's a relatively simple strategy, a simple combination that we can utilize, and it actually has many benefits in doing so. So what I did is I took a look at the YUK yesterday, and I looked at the idea that perhaps we were seeing a little bit of a support level down around that 76.5 zone, and in fact you can see this in the FX Options Weekly Outlook, which is what we were really looking at for this week. And the idea is that I may consider buying a call option at the 77 strike, but in order to offset the cost of that particular call option and to reduce the impact of the implied volatility of the option contracts, I could sell off a call option at a higher strike. So as you can see here, what I'm looking at doing is I'm looking at buying the 77 strike calls and selling off the 79 strike calls, and ultimately being able to capture the difference between the two strikes minus the premium that I've paid. Now, benefit of this, of course, as we'll see, is that we have a lower cost basis, we have a lower break-even point, and we've mitigated some of that implied volatility factor that's been added to the premium, but we cannot benefit any further than the 79 strike that we sold. So you can see here, and this actually is what I found very interesting when I was looking at creating this strategy, is that the historical volatility of the YUK is actually quite low. It's around 7.18. And just to go back to the previous slide, this you can see here within our chart, this price action has been taking place, this pair value action has been taking place in a very, very narrow range. So it's no surprise that historic volatility is low, because the pair has really not been doing a whole heck of a lot. So when we actually take a look at the historic volatility versus the implied volatility, we can see that that's in fact about 4% higher than historic. So what that's telling us is that the option premiums are starting to get a little bit more expensive, with the expectation or the anticipation that a move is going to take place. So the move hasn't taken place, but the expectation is that a move is going to take place. And what we have to understand is that when we're dealing in the options world, we're not actually buying and selling one another. We're actually buying and selling through a market maker. And that market maker is the buyer for every seller. From every seller, and they're the seller to every buyer. So they're always having to take the opposite side of the trade. And so if you think about the market maker as kind of like your insurance broker, what they'll do is, because they have to take the opposite side of the trade, let's say that there was a fairly significant number of call option buyers on the YUK. Well, the market maker has to be the seller of those call options, which means they're taking on an obligation to essentially deliver the underlying, or to cover that underlying at the strike price that's agreed upon. Well, if they have if they feel that there's significant risk of that position putting them in jeopardy, what they'll do is they'll raise the option premium, much like your car insurance broker. Even though there hasn't been an accident, even though there hasn't been a move that's taken place, the premium will be raised because of the anticipation or the probability that a move is going to take place. So in the event of uncertainty, a market maker will increase the value of the premiums to help hedge out or offset some of their risk exposure. Now, with that in mind, we can take a look at what, and again, this is yesterday, where we were at with this particular pair value. So I was really looking at the YUK 75 strike call options, and they were asking $2.85, or of course $285. By going out and selling off the December 79 calls, I was able to collect about 78 cents, or $78. So you can see that the net cost of this particular spread is roughly $2.07 per contract, or $207. Now, of course, we always have to factor the commission in. Okay, but we can recognize here that again, there is an influence on the actual net position, not just simply in the price, but we'll recognize that there's a specific implied volatility measure for the December 75 calls. There's a specific a specific implied volatility measure for the 79 call options, and ultimately we have an influence on the Greek side as well. Now, the important consideration here, just to kind of put things into perspective, is you'll notice that the vega is a reflection of the implied volatility factor. It's how much a 1% change in implied volatility is going to influence the underlying option contract. And so you can see here that the vega of the IUK December 75 call is 12.02. However, the vega of the December 79 call is negative 11.98. And the reason why it's a negative is because we're selling it. So what you'll notice here is, in fact, we have almost a volatility neutral strategy in place here. Okay, so what that means is that even though we're maybe paying a little more for the option contracts because implied volatility is relatively high compared to the underlying security, what's happening here is we're paying out this vega here, so we're buying an expensive option contract, but we're collecting in a premium here, which is offsetting that vega, and we're creating a strategy which is going to be influenced more by a move in the YUK pair value and less in any sort of expansion or contraction of volatility. So when we look at simply buying a call option or buying a put option on its own, particularly in this kind of a market environment, that is really one of the major considerations that we have to look at, because if we buy the option contract when it's too high, even though the underlying pair value might go in our favor, if we have a contraction of implied volatility, well, we could still lose money on the position.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.